As far as that and the jobs number, let's get the first reaction from the White House this morning with the National Economic Council Director, Kevin Hassett, who joins us live. Kevin, good to have you with us.
Guys.
Thanks again for joining us.
Great to be here again.
Let's start clean and just ask you how you think the street should be thinking about the jobs print.
Oh, sure. Well, you know, I think that the unemployment rate dropped. If you go to the second digit, it was almost a 2% drop. The job number for the first time in 3 months didn't surprise on the upside. It surprised a little bit on the downside. But I think that the market reaction is about right. This is about what we expected. I've heard you guys talking as I was getting wired up, and you know, the bottom line is that the jobs numbers look a little bit different than every other indicator that we have. So we just saw trade data that for October we had the lowest trade deficit since 2009. And the Atlanta Fed GDP Now number has kicked up their fourth quarter growth rate by 5.4%, which is really astonishing if you consider that our CEA estimates that it's about a 1.5% drop that you need to have to account for the government shutdown, which means that the GDP Now number is sort of like 7. And so with numbers like that in GDP and jobs here, which are a little bit lower than you'd normally have in a boom, it's something of a puzzle for markets, I would guess. But the puzzle is resolved very easily if you look at the productivity numbers. So what's happening is productivity is through the roof. It's running almost at 5% annual rate. And with productivity like that, something we haven't seen since the 90s, then you got a heck of a lot of economic growth. And it doesn't necessarily have to mean a whole huge amount of job creation. And I think that's the way I read the economy right now.
Right. I'm glad you brought up the trade numbers, though, because the imports coming in 20% makes some wonder that maybe there's not such great clues about demand, at least in terms of consumption.
Well, the thing that was really interesting about the import data for me, right, was that a lot of it was capital goods. And so all of this onshoring of production because of the tariffs was really, really visible not only in the domestic data for capital goods, but in the import data, because there's a lot of stuff, especially for like chip manufacturing and so on, that's coming from foreign countries. And so the import data wasn't just like, there wasn't just a consumption binge, which I know happens every weekend with Kramer on French wine, right? It was a consumption binge on capital goods that are going to make more chips and other things here in the U.S.
A mezcal drinker. What the heck is that? All right, so are all jobs created equal, Kevin? I mean, I was hoping to see maybe kind of flat in food services, drinking places, healthcare, and social assistance, and we start seeing some good growth in retail and steel, aluminum, the data center, utilities. It's actually the opposite. Now, where is the reshoring? Where is it happening?
Well, I mean, it's reshoring is happening with we've got data on groundbreaking. Since September, there have been, I think we're at 35 now, big factories that the president has negotiated with foreign companies and domestic companies that have groundbreaking. And the capital spending is looking really good. The orders and shipments of non-defense capital goods, you know, that we used to call it the M3 data back in the old days, that's very strong. And so again, everything is looking like the economy is ramping up at a really, really high rate. And I think that's one reason why markets are so pleased over this year with the progress that President Trump's policies have made. I was in the Oval last night talking with the president, and I was there with the chairman of the Council of Economic Advisors, and he asked us both to guesstimate what GDP growth would be this year if he hadn't changed any policies. And we both agreed that it would be kind of in the ones. And so I think all these things that we've done have really, really, really put, I guess, a shot in the arm to the economy.
Well, I was interested you gave a nod, of course, to Bill Clinton in the 90s. I guess he was doing something right. First time I always like to hear when the Democrats are praised by the Republicans. That's a good call by you. One thing I'm really struggling with, okay, which is that if I hear these 7%, I know we got productivity gain. I'm trying to figure out whether we should take rates to 4.5, 5, maybe 5 3/4. I don't know. You're more likely, according to Kalshi, than I am to be. You're in the Oval. 2 years in the Oval, David. It's an Oval. But I mean, what do we do here with the higher rate scenario that I think most conventional Fed chiefs might be looking at when you have 7% GDP?
Right. Well, the way to think about it, and sorry to be the pedantic Stanford professor that I often end up being on TV.
Well, I'm a hack Harvard guy, so go ahead.
Yeah, I know. So the point is that if you have a village with one apple tree, and then all of a sudden they plant another apple tree, then the price of apples in the village goes down. And so when you have increase in supply, you can have growth, right? The GDP of that town doubled because they have 2 apple trees, but you don't have inflation. And that's what could happen. That happened in the 90s. You go back and look, because computers all of a sudden were modernizing and increasing productivity, every business. Then you saw quarters of 6-7% growth without inflation. And it was really the brilliance of Alan Greenspan that you could have high growth without inflation when you get a really big positive productivity shock. And I think that we've got that happy thing happening right now. And so therefore you can have high growth without inflation. Of course, it'll be really, really important for people at the Fed to monitor it and make sure that that story holds. But we're seeing it in the data for sure that we've got really, really high growth and we don't have accelerating inflation.
Kevin, it's David. You know, you mentioned, of course, some of the key policies, of the administration. One has been tariffs. You mentioned, of course, a trade deficit that we haven't seen this low since '09. That may well get reversed, in fact, even hours from now. We don't know how the Supreme Court is going to rule, but I am curious as to how the administration is thinking about it. Should that come as a reversal of their authority under IEPA, and what you would do, or the administration would do, to continue those policies?
Right. Well, you know, certainly there's a high level of confidence that the Supreme Court's going to side with us. We think that we're really on firm ground. But I know you expect us to say that. And so then the question is, well, what if we're wrong about that? And it's important to think about that, too. There was a big call last night with all the principals to talk about if the Supreme Court were to rule against this IEPA tariff, what would the next step be? And Jamieson Greer is all over it. There are a lot of other legal authorities that can reproduce the deals that we've made with other countries and can do so basically immediately. And so our expectation is that we're going to win. And if we don't win, then we know that we've got other tools that we can use that get us to the same place. And, you know, I think that the IEPA authority is pretty clear. It's why it's the first choice of how to use it. But if the courts disagree, we'll, of course, respect that. But we got lots of other authorities that we could use to get to the same place.
Okay, I'd assume we'll get some articulation of that should it go against you. I asked the same question of you, but I ask it because I think it is relevant. You know, you talk about productivity. I assume you're keeping a close eye on the impact of AI in the enterprise and what that's going to mean, what's going to mean for jobs, what it is going to mean for continued productivity. How are you viewing it at this point, and what are your expectations as this year unfolds, as we all look to see whether there's going to be a return on all that invested capital, for example, for the hyperscalers, not to mention benefits for the enterprise?
Well, I think it's really quite clearly in the productivity data. There's also like case studies. There's a guy at Stanford, Eric Brynjolfsson, who's like really hitting it out of the park, studying the productivity boom from AI, and it's really quite impressive. I think that you remember back in the 90s, we're all old enough that we lived through that dot-com era. Then it was kind of, the markets were really celebrating year after year the spread of the computer, but we had a hard time seeing the effect of the computer in the data. But now we're seeing it all over the place. We've got like measured productivity is higher. Do you remember our old friend Bob Gordon had all this work that said computers aren't having any effect on productivity back in the 90s, but now we've got AI productivity estimates that are productivity's up to 4.5%. We had an earnings season where earnings surprised on the upside by more than they ever have in recent memory, and so AI is having a big effect on the operation of companies. And the way to think about it is that we've got AI has become like a really excellent coach for managers and for workers to make them do their jobs better.
All right, so Kevin, when I talk to the people who are building the data centers, they keep coming back to the same problem. We don't have enough workers in this country, both skilled and unskilled. And it's the gating factor, being able to put up all the different, say, nuclear or nat gas or just all the electricity to link up on the grid to all these data centers. What do we do about not having enough people?
Right. Well, one of the things that's happening is that we're seeing a big increase in labor force participation, and as you saw in the data today, there have been sort of two things that have reduced the growth of the labor market. One of them is the reduction in federal government employment. Precisely, which is down about 250,000 this year, and then the other is the deportation of illegals, many of them who had jobs. But native-born workers make up about 100% of the job gains that we've had this year. And the interesting thing is that that the labor force participation of native-born workers is skyrocketing. And so I think that people are getting back off the sidelines. They see the huge wage growth. Actually, think about this. The wage growth this year is probably, given today's data, is about almost $3,000 for a typical manufacturing worker.
Is this wrong, this thing in the report? Both the labor force participation rate at 62.4 and the employment population ratio at 59.7% changed little in December. These measures have shown little change over the years, so this must be inaccurate.
Well, Kevin, there's also native-born unemployment's 4.1. That's up 0.4 year on year.
Look, the native-born employment in terms of the payroll survey is up by, 650,000. The bottom line is labor force participation has been moving forward, and it's not very long ago that it was way below this. And so our expectation is, with wage growth as high as it is, at about $3,000 this year for the typical manufacturing worker, that more and more people are going to come off the sidelines. But that you're right that's one of the things that's going to have to drive growth going into this year is more labor supply, because we got all the capital spending that you can imagine. It's a capital spending boom, and you can see that in the trade data with imports of capital goods, and with the groundbreakings of the factories. There are a heck of a lot of people that are going to be putting up workers wanted signs all over the place.
Kevin, I want to move you from productivity to affordability. This news about the GSEs yesterday, there's a couple of takes on the street. One is that it's very much within the president's control and it can work pretty quickly. The other side says, what can $200 billion do in a $13 trillion market?
Mm-hmm. Right. Well, it's part of an overall plan that the president's going to announce at Davos. We've been working on it, really talking on this show over the last couple of months with a really big comprehensive housing plan. The president's going to announce the whole thing at Davos, and this is just a little small part of it to help. We see that there's a kind of hole in the housing market where people, especially between the ages of 30 and 40, aren't buying homes the way they used to. If you look at why, then there are a lot of reasons, but inflation has made housing prices go up, and then, of course, mortgage rates have gone up. And so when President Trump was in office, the typical down payment for a home for the median family was $23,000. Now it's like $32,000. And so there's lots of stuff that needs to be fixed if we can get people back into homes. And one of them is to make sure that mortgage rates are not too high. And they've been way, way too high. And so I think this is an attempt to let markets know that we're keeping a close eye on mortgage rates and that we're going to take actions like this should we need to.
Somebody that might have an impact on rates would be the Fed chair. Sounds like if you get the job, you're going to be lowering rates, Kevin.
Well, I'm really happy with the job I have here. We'll see what the president thinks about where I should be.
I did want to come back to manufacturing. Carl and Jim both sort of raising it. I'm trying to look through the numbers, but it doesn't appear that we're having the renaissance in terms of employment that we'd anticipated. You seem to think it's early, but I'd love to get a little more sense from you as to why and whether you really do believe we're going to start to see that reverse in terms of employment in that key area that was supposed to be a beneficiary of the trade policies.
Well, let's be clear that 3 of the last 4 months employment surprised significantly on the upside. Wage growth has surprised really significantly on the upside, with, again, manufacturing workers making $3,000 more in December than they did in January of the same year. And so that's the kind of thing that brings people off the sidelines into the labor market. But things are moving forward positively. What you guys are maybe worried about or griping about is that you want it to move forward faster. And that's something that we fully expect we'll see in the second half of, or the first half of this year, because the bottom line is that the factories are being built, the ground is being broken, the machines are coming in, and some worker's going to have to run that machine.
Well, I want to ask about the president getting involved with the dividend and buyback strategy of the defense companies. I know in 1962, President Kennedy did a rather radical thing. He came out against the steel companies. Execs were overpaid. He went after them, antitrust. I just basically said, this is the way it has to be. And it was one of those things where the right really felt he overstretched. I think Kennedy looks placid versus what the president wants to do in terms of corporate intervention. How do we explain this? And when you were at Stanford, were you in, I don't know, were you in Ken Arrow's classes? I mean, we didn't talk, this was not talked about.
Right. Well, the bottom line is that the president believes that we need the American defense has to be the strongest in the world. and there have been foreign countries that have really doubled down on trying to compete with us by ramping up their defense spending. Under Joe Biden, the defense spending, I think, fell back quite a bit, and in part because the spending was on stuff other than weapon systems and so on that we need should we actually have a war. And so I think that the president's view and Pete Hex's view is that we've got a lot of work to do to get back on track, and that's going to, take increased defense spending. And you'll see as we go forward into the budget debate this year that we're going to demand more defense spending. And what the president wants to do is make sure that the increase in defense spending doesn't just go into the profits, but it actually goes into the weapons that American soldiers need to protect us all.
Kevin, if tax refund season comes in as much of a tailwind as the Treasury Secretary seems to think, do you think that money gets spent or saved? And if it does get spent, does it drive some reflation?
Yeah, the history of it is that when you get a big refund season, that about half of the money gets spent over the next 6 months and half of the money gets saved, something about like that. There's a guy named Jonathan Parker at Princeton that's been studying this for his whole life. So our expectation is it would be a positive for consumption, and we're not really worried about the inflationary effects of that because we got so much supply coming online. Again, we're looking at massive productivity gains in the U.S. and really increased supply, which gives us that thing that we had in the 90s where there's a big productivity gain, positive supply shock, so you can have growth without runaway inflation. And so that the refunds are going to be great for the people to get them, because people who had tips or people who had overtime are going to get big refunds. And those refunds will help them, have a better life. But I think that there's enough productive capacity in the U.S. to have that not have significant inflationary effects.
Finally, Kevin, I don't know if you're going to be a part of the meeting later today between the president and oil executives, but I am curious as to your thoughts. We've been speaking to those same executives, not on the record, but they've indicated just how much money it's going to take, the security guarantees they would want, so many other things that will take years to rebuild the infrastructure in Venezuela. What are your expectations from this meeting later today, to the extent you have any?
I think that you're going to be very positively surprised at how quickly things move in a positive direction, in part because we've got the best Secretary of Energy I've ever seen. The bottom line is that if you go into the sort of chemistry of oil, that there are some refineries where the main byproduct other than gasoline is kerosene, and then there are other refineries where the main byproduct for gasoline is asphalt. And so refining is a lot different depending on the type of oil you have. And in the southeastern United States, the refineries have really, over the years, especially given past history, been tuned towards the heavier, sour stuff that they have in Venezuela. And so we believe that by getting that stuff back to the U.S. and doing so in a way that rewards the Venezuelans and Americans is going to be really great for gasoline prices in the U.S. because we have the refining capacity to take that particular type of oil and ramp up production right away.
Certainly explains the action we've seen in the shares of some refiners here, Kevin. Appreciate the wide-ranging time.
Thanks, always good to be here.
Yep.
Yeah.
Kevin Hassett, the National Economic Council Director.